Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to start looking at financial instruments. For me, it is considered to be the most difficult accounting standard in both theory and in real life. So, throughout this session, we are going to look at the distinction between the financial assets and the financial liability. Also, we are going to look at classification of financial assets and financial liability. It is very much important for the examination that you understand what is financial assets and what is financial liability. So basically, initially, the accounting standard that covered financial instrument is IAS 39, but now it is IFRS 9, which is financial instruments. And also, IFRS 9 addresses the accounting treatment of financial assets as well as financial liabilities. The standard was introduced to classify, simplify, as well as the incorporation of the measurement approach. Now, we are going to look at how we can measure the financial asset and how we can measure the financial liability. To be specific, financial liability, because it is the most difficult area to measure when it comes to IFRS 9. Also, IFRS 9 introduces the concept of the expected credit loss, the impairment model, which we can use for IFRS 9. If you can remember when I covered the impairment session, IFRS 9 was excluded under that impairment rule. So now we are going to look at how we can impair the financial instrument, financial assets, as well as financial liability. Also, IFRS 9 introduces the concept of hedging when we are going to look at the derivatives, the options, the futures, and the swaps. Then we are going to understand risk management practice. So basically, these are the three key areas that IFRS 9, you know, covered as compared to IAS 39. Then IFRS 9 is structured around three main pillars. One has to do with the classification and the measurement. So we are going to look at the definition of financial asset as well as financial liability. We try to distinguish between financial assets and financial liabilities. And thereafter, we are going to look at the measurement of financial assets as well as financial liability. The second important area has to do with the impairment, the expected credit loss model. Then finally, um, it has to do with the edging, the edge accounting, how we can edge, how we can reduce the exposure, the risks relating to let's assume the derivatives, for example. So we are going to look at how we can manage these various risks. So now the scope of IFRS 9, it has to do with the financial assets, the financial liability, and some contracts, very important, some contracts to buy or sell non-financial items. So we are going to look at it throughout the session of IFRS 9. Also, we are going to look at aspects that did not fall within the scope of IFRS 9. That has to do with the interest in subsidiaries, associates, and joint ventures. When we are going to cover IFRS 10, and also when we are going to cover business combination, IFRS 3 and IAS 28, we are going to look at the reason why we should not include the subsidiaries, associates, and joint venture under the impairment standard. Also, for employee benefits, IAS 19, we don't have anything to do with it. And also for financial reporting students, um, IAS 19 is out of your syllabus area. Don't worry about anything relating to employee benefits. Also about insurance contract, don't worry anything about insurance contract, but you need to know that it is out of the scope of IFRS 9. So basically, we are going to start the ball rolling. So now we are going to look at the definition of um, financial instrument. Very important. When we are talking about financial instrument, is any financial instrument is any contract. is any contract that gives rise to a financial asset of one entity and a financial liability of another entity. So for us to get a financial instrument, then it should result to financial assets of one entity and financial liability of another entity at the same time. Both should present. Now, for example, if I decided to take loan from the bank, which is clear, now the bank will give, let's assume the bank has approved the loan. So the bank will give me the cash. Then in later period, I'm going to pay the bank. So now if you look at this transaction, when I'm going to receive the cash, in other words, I am the one that's going to recognize the financial liability because I have the obligation to pay back the bank the money. Then also the bank will recognize the financial assets in their financial statement. So when there's an existence of financial asset and financial liability at the same time, that's what we refer to as a financial instrument. Anything out of the scope is not a financial instrument. If it can result to financial assets without the recognition of financial liability, we can't classify it as financial instrument. Then also, if it can result to financial liability without a financial asset, we can't look at it as a financial instrument. So a financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability of another entity. So now let's look at basic illustration so we can able to understand the definition properly. So now let's look at company company A. Let's look at company A and let's look at company B. Very good. Company A, let's say financial asset. Let's say um, financial liability, for example. So now if we're talking about financial asset and financial liability, now for example, purchase shares in company B, issue shares to company A, borrow from company B, issue debt to company A, sales of goods to company B, buy goods from company A. So now let's look at these three situations and try to understand the definition and how we can identify a financial asset and financial liability. When we are going to look at financial asset separate, and when we are going to look at financial liability in isolation, then we can able to understand this illustration better. But for now, let's assume company A and company B. Under company A, we have a financial asset. For company B, we have financial liability. Now, if company A purchase shares in company B, if company B issue shares to company A. Now, company A will recognize a financial asset and company B will recognize a financial liability. Why? Purchase of shares. Why are we going to recognize a financial asset? Because in our books, in our financial statements, we are going to recognize the shares under the equity section. And also, we are going to give out cash or whatever shares exchange, whichever condition, but company A is going to give out something to company B. So because of that reason, company A will recognize a financial asset because at the end of the day, company A will get the shareholding document, the license, the shareholding document that will justify that they purchase some shares from company B. So therefore, company A will recognize the financial asset, then company B will recognize a financial liability. So we are going to look at the second one, borrow money from company B and company B issue out debt to company A. So company A borrow money from company B. So company A will recognize um, the financial asset, whilst company B will recognize a financial liability. Why? Borrow money, it means company A will receive the cash and also company B will give out the cash. So in the banking industry, it's simple. Since the customer, company A is a customer to the bank, is receiving funds from the bank, then we are going to recognize the financial asset as well as the financial liability. The sales of goods to company B, when sales is made on credit, for example, you know, company A will recognize the receivables. In other words, in the next 1 or 2 months, based on the contract agreement, in the next 1 or 2 months, company A will receive cash from company B due to the sales, which is clear. Then also, buy goods from company A at the end. If company A, if company B buy goods from company A, then if the payment is not done at a specific point in time, company B will recognize a payables, a liability in company B financial statement. So when there is a financial asset in one entity and a financial liability in another entity, then this will give rise to the financial instrument. So basically, this distinction is very much important for you to understand. Now, also, let's assume from another end, if I, as a customer, I decided to deposit my money into the bank, it's a financial transaction. It's a financial instrument because the bank will receive the cash. So which is very clear. So we need to know how we can, account for this particular transaction. So now we are going to look at the need for the accounting standard. Very important concept. So now, in recent years, there has been a huge growth worldwide in the variety and complexity of financial instruments in the international financial market. There were numerous concerns about the accounting practices used for financial instruments, which led to demand for an accounting standard. The concerns include the following. There had been significant growth in the number and complexity of financial instruments, especially the derivatives. The accounting standard had not developed in line with the growth in the instrument. There had been a particular problem with derivatives, forward, futures, swaps, etc. And also, before, the unrealized gains or losses on many financial instruments were not recognized under the financial statement. So now IFRS 15 will recognize and will solve all of this problem. IFRS 9, sorry. Entities could choose when to recognize profit on instruments in order to smooth profitability. So there are initially they have the option as to whether they will recognize profit based on their own feelings. So now IFRS 9, has provided a solution to all of these problems. So this is the reason why the International Accounting Standard Board developed the IFRS 9 financial instrument. So under IFRS 9, we have other accounting standards that we can put together to complete the whole financial instrument. We have IAS 32, which has to do with the presentation of financial instruments. So when we are talking about the presentation, how we should show the figures relating to financial instruments in the financial statement, it is covered under IAS 32 financial instruments. Also, we are going to look at IFRS 7 financial instruments. It has to do with the disclosure, how we can present, how we can prepare, how we can disclose the notes, the financial instrument to the notes to the account. Very important concept. So when we are talking about the disclosure, we are going to look at IFRS 7. And when we are talking about the presentation, we are going to look at IAS 32. And when we are talking about the classification and measurement, we are talking about IFRS 9. And this, for financial reporting, you don't have to worry about the presentation and disclosure. You need to worry about the classification and that of the measurement of financial instruments. So we are going to limit ourselves to IFRS 9 financial instruments. So basically, what is financial asset? What is financial asset? A financial asset is any asset that is cash. And as I mentioned earlier, if a customer, if a supplier has to pay a business, then in 2 or 3 months' time, it means the business has to receive cash in 2 or 3 months' time. So we can classify that as a financial liability because the business will recognize a receivable in the books. Also, a contractual right to receive cash or an other financial asset from an other entity. Very important. As I mentioned earlier, decided to take out a loan from the bank or deposit your money to the bank, it is a transaction between the financial asset as well as the financial liability. So we can define this as a financial asset. A contractual right to exchange financial assets. The contractual right to exchange financial assets or liability with another entity under conditions that are potentially favorable. This you can understand this when we are going to look at the swap. For instance, if company A is operating in dollar, a functional currency, then company B is operating in pound, for example, and company B is at the UK and company A is in Sierra Leone. Both companies have debt in alternative currency. Company B, who is in UK, has debt in dollar, and company A, who is in Sierra Leone, has debt in UK. So they need to ensure that everyone, they solve the debt. So if they want to swap the effect of the interest rate, in other words, so that they can reduce the impact of the interest rate. So in other words, if company A is at a favorable position in this situation, then company A will recognize the financial liability. In other words, if company A in Sierra Leone will have the benefit of the exchange gain, then automatically company A will recognize a financial asset because it's favorable condition. Then alternatively, the one with the loss in the exchange will recognize the financial liability. So whenever there is a deviation between the derivatives, if it is favorable, we can recognize a financial asset. If it is adverse, or it's against another party, then we are going to recognize the financial liability. Finally, an equity instrument of another entity. Now, for example, I mentioned about it up in the previous section. If company A, purchase shares in company B, if company A purchase shares in company B, then it means company A will have equity share in company B. Then automatically company A will recognize, the financial asset. So this is the definition of financial assets. You need to know these 4 points. Very important, you need to know the 4 points. One has to do with the cash, and the other has to do with the contractual right to receive cash or an other financial asset from another entity. Then also it has to do with the derivatives, the favorable and the adverse derivatives. Then finally, it has to do with the equity instruments of another entity. So these are examples of financial assets, the trade receivables, options, investments in equity. Few examples. So now we are going to look at financial liability, which is the opposite of financial assets. A financial liability is any liability that is a contractually obligation. Now, when we are talking about, let's go back to the conceptual framework, the definition of asset and the definition of liability. It's exactly the same. The only distinction is the financial in front of the asset and the financial in front of the liability. But when we are talking about assets, the controllability criteria of assets, the inflow of economic benefit, and as a result of past event, the three features should be present. Then also, if we're talking about liability, there should be a present obligation, and it should result to outflow of economic benefits, and it should be as a result of past events. So the three features in the asset and liability should be present. So now, if we are talking about the financial liability, the liability definition in the conceptual framework is saying about the present obligation. And also for financial liability, there should be a contractual obligation, which is very clear. What should continue within the contractual obligation is to deliver cash, to pay cash, or an other financial asset to another entity. First condition, if you have the obligation to pay cash, then it means you will recognize a financial liability. For example, the sales on credit, the trade payables, the company will recognize the trade payables a liability, and it has the obligation to pay in 2 or 3 months' time for the goods purchased. So now, when there is an obligation to deliver cash or other financial asset to another entity, we can say it's a financial liability. Secondly, to exchange financial assets or liability with another entity under conditions that are potentially unfavorable. As I mentioned earlier, the UK um, um, business and the business in Sierra Leone. The UK business functional currency is pound and Sierra Leone is dollar. So if there is any exchange difference, if they decided to swap, there's any exchange difference which is unfavorable, and the company that has the unfavorable, exchange difference will recognize a financial liability in the financial statements. When we are going to look at swap, we can understand the second point very well. Now, when we are talking about the final point that will or may be settled in the entity owned equity instrument. Now, if you can look at the previous example, based on the three illustration I did, right? The issue issue shares to company A, it's another equity instrument of company B, so we can account for it as um, the financial liability. Also, the issue of debt to company A, we can account for it as a financial liability. So basically, um, the definition of financial assets and the definition of financial liability is clear. So example of financial liability has to do with the trade payables, the debenture loans, the redeemable preference shares. We are going to look at the irredeemable preference shares, and we're going to look at the ordinary. Don't worry about it. We are going to cover all of them in detail. So now let's just loosen up so we can further our discussion. Now, illustration. Identify which of the following are financial instruments. Inventory, investment in ordinary shares, prepayment of goods and services, liability for income taxes, a share option. A. Inventory or any other physical asset such as non-current asset is not a financial instrument because there is no present contractual right to receive cash or other financial instruments. It's very clear. Our inventory, we are going to account for it in our books, but we don't have obligation. It's not a must that the customer should buy our goods. No. So it is possible they did not buy the goods. It is possible they buy the goods. So in every situation, there is no contractual right to receive cash. Also, if we are going to recognize, basically from the financial statement, we have a value of PPE. we don't have any contractual right to receive cash from that PPA that is stated in our financial statement. So because of that reason, inventory cannot be classified as the financial, instrument. B, an investment in ordinary share in financial is a financial asset since it is an equity instrument of another entity. As I mentioned earlier, company A purchase shares from company B. It both equity instruments. So we can say it is a financial instrument, which is a financial asset. Prepayment of goods or services. Automatically, prepayment cannot be a financial instrument because the future economic benefit that we are going to receive as a result of the payment made in advance, it cannot result to a receipt of goods or services rather than a financial asset. So we can't say prepayment is a financial asset because the future economic benefit, that we will be receiving is a goods or services, and we are not going to receive a financial asset. Though we are going to make the payment in advance, but what we are going to pay for is not a financial asset. It's a goods or services that we are going to receive. So because of we are not going to receive financial assets in exchange, then we can't say this transaction is a financial liability. A liability for income taxes is not a financial instrument since the obligation is statutory rather than contractual. Final point, a share option. When you have the option to purchase a share or to exchange a share for share, when we are going to look at IFRS 3 business combination, the consolidation, we are going to look at when we are calculating the goodwill, how we can calculate share for share option. Also, when we are going to look at hedging, the options, we can able to analyze better. So for now, share option is a financial instrument because there's a contractual obligation that at the end of the day, we are going to exchange X numbers of shares for X numbers of shares in company A or company B or within the same company, whether we are going to, issue out shares to our existing shareholders or we are going to give a share option to employees as a result of performance. When we are going to look at share-based payments, we can cover this down as well. So basically, um, we are going to stop here for today because the next aspect has to do with the measurement of financial instruments, which we are going to start with financial liability. That's the time we are going to start digging into the concept of financial instruments. So for now, what you need to know and what you need to pay attention is the definition of financial asset and the financial liability and how we can identify a transaction. For a transaction to be a financial instrument, you need to look at the parameters, look at the factors that you can able to use to juxtapose and to justify that this transaction is a financial asset or this transaction is a financial liability. Thank you very much for your time.